Hey guys, Jerry Friedman here with part two of my Amazon accounting video series. Before I get started with part two, I just want to thank everyone for their feedback and comments on part one. As I mentioned in part one, please tag or share the video with a friend or colleague that you feel can benefit from this. On to part two. So, the example essentially stays the same. It's ABC Company as of and for the period ending on March 31st, 2018. The company correctly accounted for everything we had discussed in part one. So they had grossed up their sales, they included returns and refunds, and they broke out their Amazon fees as well. The figures change, as you can see. So the net deposit that they received from Amazon is now $200,000. So you may say, Jerry, what's wrong here? So they accounted for everything correctly. The answer is that, as some of you may know, Amazon lends money to their sellers. They lend up to $750,000 with a term of 1 year, and they typically deduct a fixed percentage or a fixed dollar amount from each settlement that they pay to you. So this company had borrowed $75,000 from Amazon, and they received the $75,000 in this deposit. So what happened is that they didn't actually break out the loan, and they had kept it included in Amazon sales income. So their sales should have actually been $115,000 as in the first example, as part one. But because they did not know what to do, they just threw the $75,000 to sales income. And really, it's quite straightforward. But before I get to that, the implications of this, besides for not understanding your company, if they were looking at March sales, right, then it doesn't accurately depict the activity that occurred in that month. But the other impact is also the tax impact as well, because then your sales that you're reporting on your tax return is increased by the amount of the loan. And you may counter that by saying, well, they're making payments over time. You are not incorrect about that, but assuming that this spans over two tax years, you really have to have a full understanding of the impact on each specific year and the impact on the ultimate tax situation of the company. And I really don't want to get into the details surrounding the tax impact, but so really let's just stick to the point of really just understanding how your company did. So they're incorrectly accounting for this. Now the question is how this should look, and it's quite straightforward. In reality, their sales should come down to $115,000. And as you can see over here, we created a new liability on the balance sheet called Amazon Term Loan for $75,000. So it's that straightforward. And as you can see over here, if you take the sales income plus the refunds plus the Amazon fees that relate to this settlement period, plus the sales tax payable that that Amazon had collected on the company's behalf and is now remitting back to the company, which the company has to now file sales tax returns and remit the funds back to the state, plus the Amazon term loan, which we just discussed. Boom, it reconciles to the net deposit of $200,000. Now, this is really only when the loan actually comes in, when the company first borrows money from Amazon. What happens when the company pays back money from Amazon? And really, it's the exact opposite, plus a little more. And I didn't actually break it out here because it's quite straightforward. It essentially, they would, instead of reducing their gross sales by the amount that Amazon is taking back, they would be reducing the term loan that is being carried on the balance sheet. So let's assume in April they paid back $5,000. You're not going to see that increase in April sales of $5,000. You're going to see a reduction in the term loan on the balance sheet of $5,000, and the new balance in this account should be $70,000. One more point I want to make before we end the video is that obviously you must include interest as well. So as the payments are taken off the settlements that Amazon is paying the company, you should be recording interest expense as well. So I quickly just threw this in over here. So essentially, every time you make a payment back to Amazon, you will be reducing the term loan balance on the balance sheet, Plus, you should be recording interest expense on your P&L as well. That wraps up part 2 of my Amazon accounting video series. Please share with a colleague and a friend that you feel can benefit from this. Also, feel free to tag anyone that may be interested in this series and that can benefit from this as well. Look forward to additional videos coming up over the next few weeks. Thank you.